All right, let's zoom in and take a closer look at the investment markets. Now that we've used principle-centered reasoning to understand that a high-risk environment is an environment in which the principles are not being honored, let's take a look at how different investments perform in these different environments. Remember, this is very important. This curve, this looks a lot like finance, and it is finance, but remember, it's integrated with our economic outlook, and that's what enables us to use principle-centered reasoning to evaluate various forms of investments. The trade-off is between yield and risk. And that means something that I think you understand quite naturally, which is that the riskier the environment, the more yield you want to compensate you for that. And a yield curve usually looks something like this. It points upwards. Why? Because the higher the level of risk, the higher the level of yield that you need to compensate yourself for that risk. Down here, we tend to have short-term investments that are in the form of lending, bonds, T-bills, etc., even money market, which is extremely short-term money. Why is that down here? Why is that low yield? Because it's almost zero risk. Treasury bonds, historically considered zero risk, but in fact there is risk even in treasury bonds. Treasury bonds are considered lower risk, for instance, than corporate bonds, because the government has the ability to print money, it has the ability to tax things corporations don't. And so as you go up along this curve, what you see is different kinds of bonds having different levels of risk and different levels of yield. The longer term the bond, the greater the risk generally, and the greater the yield. Why? Because more things can go wrong in 30 years than can go wrong in 1 year, or that can go wrong in 1 month or in 1 day. So the more you're trusting somebody to pay you back in the future, the longer the period of time, the longer the duration, the more risky you feel about what could go wrong. So what are the various risk factors? Well, there's one risk factor that I think we're all aware of, which has to do with economic growth. Now, this is going to be a little bit more finance maybe than you're used to, but if you follow along carefully, I think you can understand this. Bonds pay a yield. It's a percentage of what you invest in the company or in the government. Say $100,000 spent on a bond, and they give you $5,000 a year. That's a 5% yield. Most people are not used to thinking of stocks, however, as having a yield like bonds, because usually stocks are either described in terms of their price, a Dow of a certain level or an S&P or a certain company of a certain level, or in terms of a PE ratio, which is the price of the stock compared to the earnings. In other words, the number of years you have to wait in order to get your money back. But if we just switch that around and make it earnings divided by price, then stocks can be evaluated the same way as bonds. Stocks are like bonds in that they are promises to be paid something in the future. The difference between stocks and bonds is that the promise is not a promise of a fixed amount. You're not locking in your fixed amount. You're not saying, you know what, I'm going to take the sure thing. You're saying, I'll bet on you. I think you're going to do better in the future than currently. And so I'm going to bet that there's a lot of economic growth in your future. So the sure thing versus more of a bet. And that's why stock yields tend to be higher than bond yields. And that means that this level of steepness of the line is a measure of the risk that the market is currently putting on growth. The steeper this line, the more people want a yield to compensate them for not taking the sure thing. When people want the sure thing, that's a sign of pessimism. When people are willing to take the bet, that's a sign of optimism. So as risk levels of growth go up or down, this line either points up, higher risk, or points down, lower risk. Now there's another extremely important risk factor that affects not just the slope of this line, but everything on this line, and that's inflation. Because every kind of paper that you can invest in, from your overnight bill to your CD to a long-term .com stock, all involves a future cash flow expectation. You expect to get your money paid back to you. How much you get, well, that's a measure of risk, of growth. But they're all an IOU of some form or another. So what's the risk? The risk is when you get the money back, it's not worth anything, or it's worth a lot less than it is now. That's inflation. Academic theories of portfolio management almost always leave that risk out. But that risk is pervasive in environments where the principles are not being honored. And so, in a situation like that, when eventually the market catches up with the level of risk, this line should be much higher, much riskier. Now, why doesn't that happen right away? It doesn't happen right away because there are a number of people who don't understand the principles, so they don't see the connection between these things. It doesn't happen right away because monetary policy tends to create confusion by pushing this artificially low intentionally, and then it goes artificially high. And most of all, it happens because human nature tends to go from excessive optimism to despair and pessimism. A double-minded man is unstable in all his ways. And without principles, you and I and everybody else tend to misjudge the amount of risk, because here we think we can do no wrong. I'm a day trader and it'll always go up. And here we say, I'm never going to invest again. This market is so terrible. So, using principle-centered reasoning, you identify the proper amount of growth risk, the steepness of the curve. You identify the proper amount of inflation risk, which is whether the entire set of financial investments are not properly compensating you for the level of inflation. And to the degree that the crowd of people driven by emotion and confusing government policies are pushing these yields higher or lower than the proper valuation, to that degree that creates opportunities to buy and sell. And of course, there's also investing off this curve entirely, which is the commodities market, which tends to do very well in times of inflation, because you can print dollars, you can print yen, you can print euros, you can print any of the currencies that are out there in the world, won, baht, and ringgit, but you can't print copper, and you can't print oil, and you can't print gold. So in environments like this, where risk yields, inflation risk yields, are driving the entire stock market into risk territory, one of the ways to deal with that is commodity investing. So this is within a domestic context. Now, of course, as we know, every other country has a risk yield curve just like this, everyone with an investable market. And they're also pricing or mispricing. Someone might be excessively pessimistic about another country. See, this is 1982 in America. We were so filled with malaise. And then we had a shift in policy. And things didn't come down right away, but people who invested at these levels when there was so much risk in the market ended up doing very well for themselves. But it's not just in the cycle of an individual country. There are other nations, some of which show a pessimism that isn't really warranted because they're obeying the principles, but maybe they've had a tough spot or a recession or a natural disaster. There are some countries in the world where there's excessively optimistic, and the risk is not in the market. So this is using principle-centered reasoning. We identify the proper level of risk for a domestic market or for a national market or international markets, and then move money along this curve when we think the growth is better, take money off the curve and go into commodities to the degree that we think that inflation is coming, or look at other nations as a way to minimize our risk and maximize our yield for the long term. And that's important. This is the long term. Mood swings will always be with us. Principles keep us from getting caught up in the same mood swings as everybody else. That is the way out.